Today I'm here with Joe Withrow of the Phoenician League, which is a membership organization dedicated to helping people get better with their investing decisions and specifically with investing in US real estate. And so we're going to do an interview today. I wanted to ask Joe a few questions about his investing techniques, why he invests the way he does, and whether this membership course might be right for you folks out there.
Ross, thank you, man. It's an honor and a privilege. I really appreciate it. I can't thank you enough for taking some time to spend with me this evening. Evening for me. Now are you Mountain Time or Central Time?
Mountain time here in Minnesota.
Okay, gotcha.
Shoot,
So
no,
you
this
just
is
got off
central.
work.
Yeah. Yep. Just got off work. It's quite hot here, but
Oh gosh,
yeah,
here too. I'm ready
yeah,
for fall.
it's summer. That's how it is. Fall will be great. Well, Joe, so I'm also in a membership called Wealth Battle that's geared towards improving
Yes.
people's financial literacy. And in both courses, it's recommended to use whole term life insurance as a savings strategy. In the Wealth Battle community, they call it an opportunity fund versus the infinite banking concept here in the Phoenician League.
I like that term.
Yeah, yeah. Both are great terms for it, but why is this a better savings vehicle for people than your standard savings account or buying bonds?
Yeah, this is a fantastic question. So, yeah, the answer, had you asked this 12 months ago, you could have stopped right at the very baseline. Hey, man, savings accounts and bonds don't pay you anything because interest rates are zero. Today, rates have risen, and the benefit of that is now we are starting to see people being able to generate a little bit of a return with savings accounts and bonds, and so that is a good thing. The great thing about whether you call it infinite banking or an opportunity fund or anything, you don't have to make an either or decision. That's the cool thing about it. So if you put your money into a savings account or if you buy a bond, in either case, you get a rate of return for as long as you keep your capital there. When you take your capital out, your rate of return goes away. The beautiful thing about what we're talking about with the cash value life insurance, and it's got to be structured a specific way. So it's not just something that, you just walk into any old shop and say, I want infinite banking, and they'll set you up. Most people won't even know what it is, even insurance agents. So you got to have somebody who knows what they're doing. But if you set it up the right way, you are building cash value within that policy. That cash value is an asset to you and it is paying you dividends. And so the reason it's paying you dividends is we set these policies up with what are called mutual insurance companies. And so these are insurance companies that don't have stockholders. With their corporate structure, the policyholders actually own the company in a minority stake, just like when you buy a stock in a company, that's a minority ownership. Same thing with policies. So they pay out a percentage of their profits in dividends to policyholders who own cash value whole life insurance. It doesn't go to people who own term insurance, just cash value whole life insurance. But that grows the policy. So you get a rate of return within the policy. So it starts to grow year after year after year after year. And it starts to get exponential because you're also, every time, if you structure it properly, every premium you pay is building cash value faster than it otherwise would. There's a percentage. So basically, we're overpaying for the life insurance for the death benefit. We're overpaying for the death benefit specifically to build that cash value. The reason we do that is because as your cash value grows, your dividends get bigger. So it generates a return. Now, that return is not going to be eye-popping to anybody. You're not going to impress anybody. There's a minimum, and I think that minimum might be 2% right now. It's your actual return is going to be higher, but it's not going to be that big. But here's the beautiful thing. That cash value is yours. You can borrow against it at any time for any reason. And then what I suggest that people do, you can borrow against it and use that money for anything. If you have an emergency, there you go. You've got some funds to take it. But ideally, you don't have any emergencies, and you can take that money, you can borrow against your cash value, and you can invest in something else. So if you like savings accounts and bonds, you can invest in those too. And so now what happens is you are generating the rate of return in your cash value life insurance policy. That doesn't go away. even though you borrowed against it. And you can take the same dollars and earn a rate of return on them twice. So I prefer to take those dollars and buy new real estate with them. But you can invest those dollars in anything you want. And I can get into the specifics as to how or why that's the case if we want. I don't want to go down the rabbit hole too far. But I will point out that the beautiful thing is there is no repayment schedule when you borrow against your cash value. You do have to pay the insurance company interest every year. Right now, as we speak, my interest rate's, I think, 4.4%. And so if you take out say a $10,000 loan, you just make a payment to them for $440 a year, right?
Yeah.
That's the only thing you have to do. You never have to pay that principal back. And that's because it's collateralized, fully collateralized. So if, life insurance, the insurance company's promise, their contract is that when you die, they're going to give your beneficiary, I should say, the death benefit. Well, if you've got a loan against your policy, they just subtract that from the death benefit and give your beneficiary the difference. So there's no risk to the insurance companies. They love this stuff. They love it because they get their interest payments without any risk. So that's the reason why I really like this strategy, because you don't have to choose between what you invest in. You can do both. It's a beautiful thing. And it's all tax-free, by the way. You borrow that money against a cash value. No taxes are owed on that.
Yeah, that's the other advantage I was thinking of. And a lot of these mutual insurance companies, they've been around for a long time, like 100 plus years. So they've weathered the Great Depression, and you don't really know whether JP Morgan's going to survive the next recession.
Right.
Whereas these have come so far through so many recessions, and they just become bulletproof.
Yeah, and another thing I'll point out is, as we've got rising rates, these insurance companies are ultra conservative, and they're buying, high quality mortgages, and they're buying high quality bonds themselves. And so as rates go up, their returns are going to go up, which means our dividends should go up. That's we don't know for sure until we get the dividend check, but theoretically they should benefit from rising interest rates, and therefore we should too.
Yeah. And these are folks who they're actuaries. They've got a science of how to do this and how to invest in these low risk investments where an average person with a job would have a much harder time doing something like that.
And it's 100% reserve. JP Morgan can lever up 10x on every dollar that somebody deposits with them and do whatever they want with it. Whereas the insurance companies, they only have to invest whatever is the difference between their income and their expenses. So, there's no leverage involved, which is a big reason why they've all survived and plenty of banks have gone bust.
Very good. All right. So what's a good rule of thumb on how much cash to keep on hand to stay liquid before making an investment deal? I was kind of floating out the idea of 10% of your wealth in cash equivalents. And you mentioned that in the capital allocation a little bit in the course.
Asset allocation model.
Yeah. And what about 3 months of expenses? What's a great lower bound for people?
Yeah, so I've got two thoughts on that. Absolutely, first things first, just getting started. I think 6 months worth of expenses is where you start. And that's, your mortgage, your utilities, your car payments, any other fixed expenses you have. Probably factor in whatever your average grocery costs are, whatever you're comfortable with. Make sure you got 6 months to where if something happened and your active income went away, you've got some time to figure it out. You can pay your bills and determine what your next move is. So that's where you start. But then the approach that we advocate in the Phoenician League is the asset allocation model, which we're talking about allocating a percentage of your net worth to cash, gold, Bitcoin, stocks, potentially bonds, potentially early stage investments. For the first several of those, cash, gold, Bitcoin, stocks, I see those as cash equivalents. And so I really see the entire asset allocation model as cash reserves. So to me, it's not retirement savings. This isn't trying to create financial independence. It's trying to create financial security. And the reason I see the cash, I'm sorry, stocks, gold, Bitcoin as cash equivalents is because we can sell them tomorrow for cash if we want to. There's a liquid market at all times for those assets. The difference is we have a reasonable um, reason to believe very strongly that those assets will, at least, especially gold and Bitcoin and stocks, if you're in the right stocks, they will likely appreciate at least in nominal terms over time. They may appreciate in real terms too, and in real terms meaning inflation adjusted. We know when you've got a $32 trillion debt, when you're running $2 trillion deficits, and you're doing all these crazy shenanigans at the monetary level. Speaking of the our national finances here, we know that there's going to be inflation, which erodes the purchasing power of the dollar. So to me, it's you want to have some cash because if you absolutely have an emergency, you need to have something right now. But we don't want to load up on cash because we can also invest in stocks and gold and Bitcoin and still have the same security, but with a reasonable chance of those assets appreciating and purchasing power. So the way I look at it is this. So when we talk about an asset allocation model, and we're talking about we should contribute a percentage of our net worth, or however you want to word it, to these assets. The way I look at it is I want my entire asset allocation model, the total amount of money that's in all these different assets, that to me is my financial security. So I'm picking a number based on my own circumstances, whether that's 30,000 or 50,000 or $100,000, whatever it is. That is my reserve fund. So I'm saying we'll just use 100,000 for easy numbers. So if I say I want 10% in cash itself, well, what's that, 10,000, right? On $100,000. And if I want, so it's very easy, and then I want this percentage in gold, this percentage in Bitcoin, this percentage in stocks. So I'm just basing that on my overall number that I say, I want to make sure that I have this amount in reserve. So if anything happens to me, if I have an emergency, I've got cash. And if my cash isn't enough, I can convert these other assets to cash. So that's the way I look at financial security. To me, that's not retirement. That's just basic security.
Yeah, that makes sense. And with planning out those 6 months of expenses, you need to know what those expenses are, and that's where a budget comes in. Yeah. So that's definitely a recommended step for anyone trying to really improve their finances. All right. Well, with the Phoenician League, we've got a program of buying real estate as a cash flowing asset. Now, specifically, we're dealing with real estate in particular states that are this particularly friendly towards businesses, towards landlords. But when I think about owning this real estate out of state, it feels scary. So why do we want to go afar for this cash flowing real estate rather than buying stocks or investing in local businesses and real estate here where we're at?
Yeah, man, this is a fantastic question. And to me, it all comes down to the network. So when we're investing in the Phoenician League, we're investing through a nationwide network to where we've got brokers on the ground in 12, 13, 14 U.S. cities, large U.S. cities, brokers on the ground. They've got relationships with new home builders in those markets, as well as the flippers, whether that's, a company that's buying old houses, fixing them up and selling them, or, there's mom and pop, couples that'll do this too, just independently. So they've got, our brokers have relationships with these people to where they source high quality properties that are in great conditions. They know the neighborhoods in the area, so they know which neighborhoods are good, which neighborhoods you don't want to walk in, you don't want to invest in either. It's go hand in hand. So they know all these things. So we leverage their expertise. Our network has lenders that are licensed in these markets that can help us secure the most advantageous financing for any properties in the area. We've got a master insurance policy that essentially we've got an insurance company that treats all of us investing through this network as if we're all one entity. Wow. Because we're driving so much volume. So we can get a discounted insurance rate, same rate that, say, a hedge fund could get or whatever, just for buying a bunch of properties. because collectively we are, even though I might just buy one or two houses, they're treating me as though I'm the same as everybody else. Then the other thing, and this is the most important thing at the end of the day, we've got vetted property managers in those markets. And so the property managers are the people who are going to go out, they're going to market your property, they're going to find the tenants, they're going to screen those tenants, do a background check, do a credit check. They're going to get, basic information, make sure they qualify. Then they're going to sit with them and go over the lease and go over all the terms of the lease. And then they're going to collect the security deposit, and then they're going to collect rent. And then they're going to we pay them between 8 and 10% of the monthly rent. And in my mind, some people are like, man, that's a lot. In my mind, it's like, wow, I would never do what they do for 8 to 10%. Because after they lease that property, if there's ever any issues, tenant calls them.
Yeah.
Calls them. And typically with the property managers, we have an agreement where any repairs under a certain amount, whether it's 250 or $500, if it's below a certain amount, we've got an agreement where they just do it. And then they just subtract the expense from the next monthly rent check. Anything above that, they have to go out and they get quotes from various contractors or handymen or whoever that they know. And then they send those to us and say, hey, here's the situation, here's the quotes, let me know what you want to do. But those are the most important people to have on your team because they're taking care of your investment and they do all the work for you. So you don't even have to do anything other than check every month to make sure the rent check came in. So I would never invest out of state without going through a network like this.
Yeah.
And the beautiful thing about the network, so I mentioned we pay the property managers 8 to 10%. So if I own so let's say I own a house that generates $400 a month in cash flow, or I'm sorry, we pay them based on gross rent. So let's say it generates $1,000 a month in gross rent, and I pay them 10%. So that's $100 a month, right? So if it's just me with one house, $100 a month probably isn't that big of a deal to their business. Now, ethically, they should do a great job for me and treat me great, make sure that they're doing what they're supposed to be doing. But as a financial incentive, if I get upset and leave, it's really not going to hurt them at all. However, we're investing through a network. These property managers know we're investing through a network because collectively we are their largest client in all the cities we're in. So now I might just have one house and I might just make them just a tiny little bit of money for their business. But if they don't do a great job for me, what happens? I'm going to go back and I'm going to tell other people in the network and I'm going to say, hey, I think we should move. And if other people are like, you know what, I've been having problems too. Well, we're definitely going to move. And then all of a sudden, it's not just me who they risk losing, it's everybody.
Yeah.
And so their business could dry up. So really there's a very strong incentive for these property managers to treat even the smallest investors the same way they treat people with tons of houses with them, if that makes sense. So that's why I am confident in investing out of state because I've developed, and anybody investing through our network is going to develop relationships with all these people, and you get to know them, and you're talking to them regularly, and all those things. And so that's the key. So why should you do this rather than investing in local businesses or local real estate? Two different things there. So in terms of local real estate, for people who know what they're doing, and if they live in a really good market to where, the numbers make sense, they can get good cash flow, all those things. Yeah, I mean, great, go for it. You still either have to manage that property yourself, which could be a headache, or you still have to pay a property manager, but it's all good. The beautiful thing about having a nationwide network is markets change. And so, for example, several years ago, both Boise, Idaho and Dallas, Texas they were great markets to invest in real estate, produced great cash flow, all those things. Today, not only do they not produce any cash flow, they produce negative cash flow.
Wow.
And so, and we still got our infrastructure there, but right now it's just sitting there. We're like, hey, we'll let us know when things pick up. And that's because property values skyrocketed.
Yeah.
And rents have gone up a little bit, but they haven't skyrocketed. So you just can't get the same cash flow. So the beautiful thing about having a nationwide network is you can just always go to whichever markets work the best as far as cash flow numbers. And when you have a situation where you've been in the market, say like Dallas, and you've got some big capital gains. Well, now all of a sudden, if you wanted to, you could sell those properties, do a 1031 exchange to roll the money you made tax free into new properties into a market where the numbers still work really well. And so you could take your 1 or 2 properties in Dallas, say, and turn them into 4 or 5 or 6 properties in Birmingham, Alabama, or
Oh,
wherever it is. So it's almost like an arbitrage opportunity in a sense. And so that's the great thing about having the network. So invest locally by all means if it works and you know what you're doing in real estate. As for local businesses, I'm all for it. I think in the state of the world today, I mean, you go back 100 years ago, and as a society, we abdicated our responsibility for core civil services at the local level. We said government's going to take care of it. And of course, those jerks neglected all of it. So now we're in a mess today, and we've got crumbling infrastructure. And in many places, including the place I am, the municipalities are struggling to keep up with everything. And of course, what do? They clamor, well, we need more state money, and the states say, well, we need more federal money. So it's just like trying to take money from everybody else. And I look at that and I'm like, man, what if we had individuals on the ground who stepped up and figured out how to get this stuff done? And maybe that's a business, maybe that's a nonprofit, whatever it is, we can figure this stuff out. So I'm all for supporting local. But if you're going to invest in a local business, you know, there, there's no liquidity there. There's no exit event. That business isn't going public. It's not going to get acquired. So once your money goes in, it's there unless somebody else is going to buy you out. And yeah, maybe you can get, maybe they're going to pay you dividends or whatever it is. I think all that's great, but to me, that's an entirely different investment compared to real estate. So I
yeah.
like it, but I would think that that's something, I see it as much riskier. And so that's something probably somebody would want to consider once they had already kind of established a very strong financial foundation in all the
Mm.
other places.
Yeah, and
Is my
it's
thought.
not going to be diversified, right? Your local auto
Yeah,
mechanic or whatever it is.
yeah,
So, if you are really passionate about your local businesses, I think that's a good way to go. But having that insider information could be the key there.
yeah.
What
And then
makes
the
the
question
best
also is, all
business?
right, if you're going to invest in that business, what are they doing with the money? What do they need that investment for? Is it because they need to hire somebody, and because they whatever it is. I mean, I think that's an important piece too. I don't think we want to just invest and then the guy takes a vacation to the Caribbean or something. It's like, thanks, Joe. I'll see
Yeah.
you in 6 months.
People need vacations too, but yeah, I hear that.
Yes, yes, all for it, but not with investor dollars.
Yeah. All right. Well, it's really hard for people to time the market, like especially the stock market, in terms of making trades at the proper time. Is it wise for people to learn technical analysis, to hire someone to help with timing, or to just use some sort of simple heuristic, dollar cost averaging, market and limit orders? How do you navigate?
Yeah, yeah, good question. And I've got two thoughts on that. And I think it depends on what are you trying to accomplish? What are what are you looking to do? And when we talk about asset allocation, and within the Phoenician League, we've got a portfolio of equity investments that we've done professional analysis on. We know the key performance metrics in the industries. We know how to compare these companies to their competitors. And then we look at the valuation metrics and we can determine, okay, even great companies and great industries are very bad investments if you buy them when they're overvalued. So we're looking at the valuation metrics, and if something's overvalued, I just put it on the watch list and say, okay, when it comes down, now I'm interested. But until then, so we only buy when all the numbers make sense. But we are not timing the market. I mean, in a sense, that's kind of timing the market, but not in the manner that you're speaking of. And so for those types of investments, dollar cost averaging is the way that I look at it. If I say I've got 8 companies that I really want to build an equity portfolio around, and I want to have whatever percentage in stocks, and I want to have split that percentage up, evenly against these companies, well, then I can, dollar cost that rather than just buying all of one and then wait to save up money and buy all of the other. I could potentially dollar cost average and buy all of them a little bit over time. Um, so that's my approach. I don't worry about trying to time tops and bottoms or anything like that. And with the investments that we're doing in the Phoenician League, these are all driven off big picture trends. Some of them around energy, and some of the I guess anomalies that have occurred recently. But I'm content. I track these things and I make sure I've got an investment thesis, and I make sure that everything I'm seeing is continuing to validate or at least not invalidate my investment thesis. As long as that's the case, I'm in them for years. I don't want to trade in and out because I don't want to get hit with taxes, and I believe in the opportunity. So I treat those separate. Those are long-term holdings. Now, I also do think it's fun to play around in the markets, and a lot of people do. To me, that's a separate thing. When you start getting into, I want to trade, that is different from investing. And so what I would do with that is set up a separate brokerage account with a set amount of funds that you put into that account. And maybe you contribute monthly and you say, all right, I'm going to put in X dollars monthly to this account. And that's kind of play money. And then there's all kinds of things you can do. There's all kinds of trading strategies. There's all kinds of market timing things. And I've tried a bunch of them. And I know people who've made their living trading. And what I can say to people is this. Many of them work sometimes. Some of them never work, but many of them work sometimes. I don't think any of them work all the time. And you talk to professional traders and they'll be upfront with you. And typically they've got 2 or 3 kind of strategies, and they'll do one for as long as it works. And when it stops working, they'll say, okay, we'll set that down. Let me do this other strategy here. And if that works, they'll keep doing with that. So they jump around. And so, yeah, you do have to. I don't know that I would pay anybody to manage it for you, but it certainly might make sense to pay for whether it's courses or educational material or whatever it is, just to learn. Because to me, I don't think many of us are going to build long-term wealth by trading in and out of the market. To me, that's more entertainment. Like if you just want to be involved and do something, we'll do it with a little trading account rather than with your long-term account. Let that sit and just play around over here. So that's my thought. But there's all kinds of resources out there and all kinds of philosophies, all kinds of mechanisms. And the traders will fight with each other over, whose is the best and all that stuff. But I see that more as entertainment than anything.
Yeah. Yeah, and I tend to be a buy and hold type of guy. But kind of just like looking at my 401k, I'm like, hey, there's a lot in here and I can't do anything with it. So there's a trick there. And it's being managed by this third party, right? So
and that's tough, man. I personally, I made the decision. It's been a while back now, but I liquidated my 401k and my IRA specifically for that reason. It's like, man, I don't really believe in these investments. Yes, I was getting a match and all that stuff. And yes, I had to pay a 10% penalty in taxes, but it's like, you know what? I want to take control of that money. So that's not something I recommend that people do. But you can do it if it makes sense for your circumstances. There are definitely drawbacks to doing that, but I don't like it. And it goes back to the infinite banking or opportunity fund. That's what's so great about it. You can see your funds start to build up, and you know what, when it gets to this certain point, I'm going to take it out and I'm going to go buy some real estate, or I'm going to do whatever else with it. And so it doesn't lock your money away. There's no arbitrary restrictions. And so that's just another bonus with those types of strategies.
Yeah, that's fantastic. And I've got to get that opportunity fund to the level, right, to make some of these investments.
Yeah, and that's the thing. It takes time. It takes time. I mean, anybody that's going to do that, it takes 3 or 4 or 5 years for that thing to break even. But after it does, it's a beautiful thing when you say, yeah, I mean, just pick a number you're paying. I like to pay my premiums annually. So just pick a number, maybe say $4,000 a year that you're paying, and you pay that premium. And then the next week you look at your cash value and it just went up, $4,500. It's like, you just made $500 just by giving them 4,000, 4,000, whatever it is. So it's a beautiful thing when it does start to generate a return, and that grows exponentially over time.
Awesome. Well, thanks, Joe. So you've got a couple things going on. There's the Phoenician League course, and membership. And then you just came out with a book.
Yeah.
So tell us about the book.
Yeah. So the book's titled Beyond the Nest Egg: How to Be Financially Independent Outside of a Broken System. And my goal with the book, it's broken down into three parts that tie into one another. And the first part is all about the macroeconomic situation right now. So I look back and I look at the period from 1982 to 2022, and I call that the age of paper wealth. So if we look at, if you look at the chart of interest rates, and you can use the 10-year treasury rate as a proxy, and look at a chart of the US stock market, and you can use the S&P 500 as a proxy. From 1982 to 2022, interest rates did one thing, and that's go down. Now, I mean, there were some fluctuations in there, but the overall trend was down. Stocks did one thing. They went up. There were some corrections. There was Black Monday, and there was the dot-com bust, and there was the 2008, and then there was the COVID stuff. There were corrections, but the overall trend was up. So you could just invest in any old index fund in the stock market, and 5 years later, you're almost guaranteed to have made money. I don't, and then so what happened in 2022? All of a sudden, the Fed started to aggressively raise interest rates. And at first, everybody was saying, oh, they're just raising now so they can cut later, and then it's going to be off to the races, and we'll be back where they were, and they're not going to keep doing this and all that. Well, they were basing that on, number one, the history of the last 40 years, which generally, if something's happened for 40 years, it's a pretty good bet that it will continue. But they were also basing it on the idea that the Fed was fighting consumer price inflation. I don't think that was the case. Inflation was more a symptom of what was going on. So the first part of the book talks about that whole dynamic, what I believe the Federal Reserve is doing. Then we talk about the kind of some other big picture macroeconomic trends that suggest to me that we are in uncharted waters, in the sense that rates are higher. I don't think we're going back to a situation where we're going to see mortgage rates in the 2 and 3s ever again in our lifetime. That's my opinion. So first part of the book talks about the macro stuff. Then the middle part of the book talks about our approach to building financial security through asset allocation. And we compare that to the old nest egg model. And I know you're familiar with it. I remember seeing commercials where there'd be people walking around and going about their life, and they had little bubbles, right? Little text bubbles following them with a number on it. Maybe it was 1 million. One guy might have had 3 million. Another guy had 650,000. And the commercial was like, "What's your number?" "Oh, you don't know? Well, come in and talk to us so we can figure out your number." And the whole premise was you pour all your savings, or not even all you pour a small percentage of your savings into financial assets, probably through qualified retirement accounts like 401ks and IRAs. You build up to this magical number. Once you get this number, then you can retire, and you sell those assets, and you use the proceeds to fund your retirement and to supplement your Social Security or whatever else you had going on. And what they ignored completely was the fact that whenever you sell those assets, number one, you're drawing down your asset base. And number two, you're paying taxes on that. Yeah. So you're drawing it down even farther than you would need to. And so with that model, it's always a choice between assets and income. While you're working, you're building up assets, but your income's where it is. Then when you retire, you sell off your assets to get more income. So it's a seesaw. And the tax code's against you. And so with what the model we suggest is we want to put assets and income on the same team. So the first part of that is asset allocation. That's our financial security. And then we use that as a jump off point to start building passive income. A couple ways to do that. I think rental real estate is the best because it is incredibly tax advantaged. And so if we do that, all of a sudden we've got assets and income on the same team. So if we want to get more income, all we got to do is just buy another asset. And so both go up. And we've got the tax code on our side, because with real estate, if you do it properly, the way we advocate, you're not going to pay taxes on your rental income. You're not going to owe taxes on your rental income. Like we're not doing anything shifty or, it's all right there in the tax code, all by the book. And so that's what the book's about. It kind of contrasts the two philosophies, and then it walks people through exactly, hey, if you're interested, here's some steps you can start taking or at least learning about. If you want to go more in this direction. So the book really very much is kind of an encapsulation of the philosophy that we talk about in the Phoenician League, and that's what it is, and it's just with a macroeconomic tint to it, I guess.
Awesome. Well, thanks so much, Joe, for this interview. And let's try to get the links to the course, the book in the show notes. And I'd like to link my website also below
Yeah, man.
so people can check it out.
Yeah, Taras, thank you very much. I appreciate it, man. This is great. I love talking about this stuff and love hanging with you, man, after work. So appreciate it.
Sweet. All right. Thanks for watching, people. Peace.